So now we know how to calculate XIR, and let's spend some more time in understanding few more important backtesting metrics or whatever, how you evaluate your investments. The basis for this is something called CAPM, that is Capital Asset Pricing Model. It's basically a methodology where you report your returns and risks and all those metrics. So a user or buyer of your investment, either it could be mutual fund or in the ETF or whatever, can decide. And what are those metrics? It's basically around 5 metrics. One is alpha, then beta, then standard deviation, which we already seen in the last session. And then there is an R squared, and then Sharpe ratio. This terminology might look complex, but let's try to simplify, because these are the industry standard terms. Now, what is alpha? It's basically an edge. Is your investment choice is able to beat the market. What is the market here? Nifty 50. Suppose Nifty 50 has given 10% returns. And your investment, probably you selected gold or you selected some other mutual fund XYZ. Let's say if it has given 15%. What is the excess returns you are generating? What is the excess returns? Because Nifty has given 10% and your portfolio which you have chosen has given 15%. So there is an edge.
5%.
10, which is 5%. Right? Now that is your normal returns. But to generate that 5% returns, you would have taken some risk. So you adjust with that risk factor, whatever is the risk. That risk is nothing but beta. Now you recalculate your returns, which are 5%, adjusted with beta, you will get an alpha. So it's not 5% returns, it will be adjusted by some factor. It will be less than 5%. So that is what your real edge. If you don't have alpha, you might as well invest in market, which is Nifty 50 in this case, in our case. So this is the formula for alpha. Sometimes alpha is also called as Jensen's alpha. And it's a simplified formula, which is nothing but return on portfolio investments minus the whole of the bracket. RF is risk-free interest, risk-free return, plus B, that is beta, into market returns minus risk-free returns. Now, if you are lazy or you don't have the data of risk-free returns across all the years, the simplistic method is either you can take all the last, suppose you are calculating alpha for the 10 years period or last 5 years period, you take average interest rate, that is your risk-free rate. Or if you are lazy, you just set it to 0 and commit the same mistake across all the comparisons. So nobody will question, all the mistakes will nullify. Now to calculate alpha, you need beta. What is beta? It is simply an estimate of how much my portfolio moves by a factor of the market movement. Let's say beta is 1.2 and Nifty has given or is up by 1%. How much your portfolio would have moved? Beta is 1.2 and Nifty gain is 1% today. So how much your portfolio moved?
0.3.
1.2% by a factor of beta. Let's say now Nifty is down by 2% today. How much your portfolio would have moved?
Somewhere close to minus this 2%.
1.2.
1.2.
1.2 into minus 2, right? That is your beta in simple terms. Now, how do you calculate beta? You set a period, like I want to calculate beta for 10 years or for 5 years or whatever. And there are two methods. One is slope, the other one is covariant where method. You can do calculation in either way, but the simplistic thing is it's a one-line formula. So slope, we'll do via slope method. So Reena, if you can open your Nifty and Bank Bs.
Sure, I'll just.
Your screen.
Yes. Okay.
Okay, so now come to Bank Bs. Or okay, open a new sheet. After auxiliary, you write CAPM, CAPM. And what you do is get the Nifty Bs returns. Go to Nifty Bs. Get the Nifty Bs returns. So just get A and B. A and B, entire A and B. Copy. Paste it. And get the Bank B's value. Because the date it's the same. So just get only the Bank B's.
Okay.
Right, so now you calculate the returns of Nifty Bs. So returns D1, escape. D1, Nifty returns. And Bank B's return, bank returns. Enter. And bank returns. E1 will be bank returns.
Just a minute. Okay.
And in the D1, the formula would be B1 into D2. The formula would be B2 into 100 divided by B3.
B3.
Minus 100. Just simply the percentage minus 100. Enter. And the same for Bank Nifty.
Yeah.
Yeah. Copy all of them. Just come down. I want to see how it copied in the last A100 or whatever.
Okay.
Remove that due by 0. Delete all the values. Even delete 6.97. Let that be. Delete that 6.67. Now change the precision of D and E to 2 because it's too ugly to read.
Okay.
Both D and E at one go. Remember?
Okay.
So now your formula for beta. So write in H2 or H3. H3. Write in H3. Not H3. Is nothing but slope of known Ys, right? So now instead of that, delete that, write in L2, L3 somewhere. Delete, right? I'll tell you what to feed in slope. So known Ys are, right? Known Ys are bank Bs. Known X are or not bank Bs, underlying, which is underlying. Known X are underlying benchmark. So it is Nifty, underlying, which is Nifty. Enter benchmark, which is Nifty.
Sorry.
And so you just need to plug those. Now come to I2 and slope. Of known Ys, which is E. E2 to E100 or E2 to E enter. Come down, select all of them. Comma, known X, which is D. Enter. Close the bracket and enter. So reduce that to number. So what it means is beta is
1.4.
now open the slide deck. Yeah. Beta slope method, that's how we calculated. So for the bank Nifty on a monthly time frame, we got a beta of 1.4. What does it mean? Come down. Next slide. Next slide. This is what beta interpretation is. So beta is greater than 1 means the bank fees are more volatile than market. If it is 1 means it's exactly the same as Nifty. If it is less than 1 means it is lesser volatile. If it is 0 means there is no relationship or correlation between Nifty and your bank fees. Sometimes it could be negative also. That means both of them are moving in opposite directions. In our case, beta is 1.4. Now go back.
Okay.
Go up the slides.
Okay. Slides.
No, in the slide, go to alpha. Yeah, copy that formula. Alpha equals to whatever. Paste it in Notepad. Open a Notepad. Paste it there. Oh, go and copy and we'll write this. Again, actually, RA, you can calculate, you can copy the other one also, other items. Yeah, now copy this into your CAPM sheet. So we'll calculate alpha.
Okay.
After beta, you write alpha and you paste that. So because you don't know how to calculate them, or we are referring and we are recalculating alpha.
Okay.
Right, so it is nothing but average returns. So RI is average returns, right? So write before alpha, you insert one more column. After beta, you write Nifty returns. Is nothing but average of Nifty returns.
Okay.
Yeah. You calculate average of Nifty, that average of D of D. Average of D of D.
Sorry.
Enter.
Hmm.
Bank Nifty returns. Again, insert one more and that's not going to help. Just push alpha down, cut that and write it down.
Okay. No, because I also had this thing.
Yeah, okay.
I put this corresponding stuff here.
Okay,
Okay,
now
no
write
problem.
Bank Nifty returns.
Okay. Just a moment. Okay.
Now we are calculating, is there an alpha in Bank Nifty, right?
Yes. Okay.
So in the alpha you come equals to RI, which is Bank Nifty returns, 1.27 minus our risk-free rate is 0, so we don't bother. Open a bracket, open a bracket. After minus, you are opening a bracket.
Okay.
0, RF is 0, right? 0
Plus
beta into bracket, then bracket market returns, which is Nifty returns, minus risk-free rate, which is 0. Close the bracket.
I think
Close the bracket.
more.
Enter.
Okay.
So basically, your alpha is negative.
Okay.
That's a negative number, right? So you can highlight conditional format. Highlight cell rules, less than 0, light red fill, light red fill.
Okay.
So that's a negative alpha, and that is a monthly alpha. So to convert that into yearly alpha, you simply multiply it by 12. Right? So there is no alpha in investing in Bank Nifty. It is a negative alpha. Even though the returns of Bank Nifty looks higher, but because you are taking a higher risk, there is no alpha. You are looking at basically whether there is an alpha or not.
Okay.
Right. So the next slide.
Okay.
We are done with alpha now, and we have already calculated beta. So come down.
Yes. This also we did.
Yes, we have done this. Next, we also know how to interpret beta, and then we have a statistical term called R squared. R squared is basically you first calculate correlation and then square it.
Okay.
In statistical terms, it is variation of dependent variable is explained by independent variable in a regression model or whatever. But in investing, what it means is how much your benchmark and your portfolio are moving in tandem. Right? Now let's calculate alpha. Sorry, R squared.
Yeah.
It is nothing but after alpha, you write correlation. of bench array 1 and array 2. It doesn't matter in whatever the format you give, it will be the same. So array 1 would be D and array 2 would be E. Right, so now again you do in reverse format. Just for your understanding, we copy that same formula. Next, in the JJ, copy it and write corral.
Where? Below?
Next to 0.88. What I want to show you is equals to, right? Equals to.
Yeah. Sorry. Yeah.
Now you change like E and D you put. Instead of E and E, you put E and D, comma D and D.
Okay.
Enter. So it doesn't matter whatever the order you give, it's the same value.
Okay.
It's true for like correlation, so you don't need to bother. Now R square is simply power of that, square of that. So R squared.
Just a moment.
Is equals to correlation power. Power is shift 6. Change that into smaller. Okay. And you express that in percentage terms. So into 100. 5 there only into 100.
Okay.
Right. So what it means is now we have Nifty returns and Bank Nifty returns, right? So the actually it should be in other order. Right in the F you write again Nifty returns.
Okay.
It is simply copy of D.
Okay.
No, I think the formula got. So in the F2, go to F2.
Just a moment. Let me see if I copy it as values.
No, you copied it wrong. So let it. Okay, now it's correct. Okay.
Yeah.
Number and change it to 2 digits. Okay, so now what you do is we are plotting a graph. So plot a graph of E and F. Insert. Recommended charts. Scatter plot. Or scatter plot. The next one. Say okay.
Just a minute.
Your Nifty returns and Bank Nifty returns, right? So you can delete that. And what you do is you draw a best fit, which is select that plus.
Shall I remove this?
Remove that. I just want to explain what R square is, right? So select the plus, select the plus, select the plus. On the right of the chart, there is a plus. Above that plus.
Okay.
Right. Remove grid lines and axis. Even axis also. We don't need them.
Okay.
And draw a trend line. Right, so that's your best fit. That's what is called a regression line. Now, some data points are right on the line or next to line, and some are all over the place, like especially the top blue dots or down blue dots, right?
Yeah.
Now, R square tells you is 77% of the data points. If there are 100 data points, 100 dots, 77 are closer to them, closer to that line, and 23 are outside the line. That's what R square is. Now, how do you interpret? If it is a number is 100, you are mimicking Nifty. If the number is 77, which means 77% of the times you are mimicking Nifty, and 23% of the times you are not mimicking the Nifty.
Yeah.
So what our preference would be, if somebody is telling I'm mimicking Nifty, why should I invest in him? I might as well invest in Nifty. So I don't want you to mimic Nifty. If R square value is something less than 70, 60 or whatever. At the same time, I want alpha, right? So that's how I view in both. I want positive alpha. I want R square to be lesser number, right?
Yeah.
Okay, now go to the next slide. Now the final metric is
Sharp ratio.
so open a notepad. Write whatever is I think it's text. So write RP minus RF
Just a moment.
in your notepad. You can't edit. That's a picture. So
Okay. Oh yeah, there's no way I can.
I'll read it for you. You open a notepad. RP minus
RP.
right, RP, that is portfolio. In bracket you put RP, RF,
RF, comma RF.
and then what is that? Divided by standard deviation of portfolio excess. RP minus RF divided by bracket, you put both brackets. And at the end of RF, there will be a bracket. Divided by standard STD of portfolio excess returns. Excess, EX. Yeah, copy that and go into your Excel sheet. Drag that chart towards the right. Drag it. Keep it somewhere. Oh, that's fine. After R square, you write sharp ratio. And your formula you copy in somewhere L. Whatever is in the notepad. Right, so to calculate this, our portfolio is Bank Nifty right now. And Nifty also we can calculate. So insert 2-3 columns after F. Right, so now, yeah, so put risk-free rate in the G. So what's your risk-free rate now? 4%, right? So equals to 4 divided by 12. And we're assuming 4 across the period, but we should, if you are not lazy, or go and plug all the rates like that. Now write Nifty excess returns. Is nothing but Nifty returns, which is D2 minus risk-free rate. Enter. Write Bank Nifty also at one go. Bank Nifty returns. No. Right? Don't copy like that. Write a fresh formula. Delete. Bank Nifty returns. Where are they? E2. E2 minus risk-free rate. Enter. Okay, so now you are calculating Nifty Sharp ratio and Bank Nifty Sharp ratio, right? So Nifty Sharp ratio is nothing but RP, right? Which is average Nifty returns. It's already there in your M3 equals to, open a bracket, your Nifty returns are in M3. Come down, M4. That's where your Nifty returns are, right? Minus risk-free return, which is 4 by 12 or G2. Close the bracket, divided by standard deviation of ST dev right, instead of selecting ST DEV P in brackets your Nifty excess returns, which is H, entire H of H. Enter. That's your Nifty Sharp ratio on a monthly. So now to convert that into yearly, you have to do square root of 12 multiplication. Yearly. Reduce the precision so you can read it properly. No, reduce the precision of that 0.164 or whatever, right? So just make it 0.16. Number. No, make it 2 digits. Yeah. No need of separator. No need. And yearly is equals to square root equals to M17 into square root of 12. Right now, do the same for Bank Nifty. Equals to, come down. Bank Nifty returns, yeah, minus your risk-free rate, which is 4 by 12. Bracket close, divided by standard divided by ST div P of Bank Nifty excess returns, which is an I of I. Now yearly is yeah, that's correct. M19 into square root of 4. Enter. So now the thing is, higher the Sharpe ratio, it is better. The range would be like 2 is very good Sharpe ratio, 1 is average, something like that. But we can't be choosing because we don't have options of greater than 2 Sharpe ratio. So now given these two, Nifty is 0.57 Sharpe ratio and Bank Nifty is 0.44. So higher the Sharpe ratio, the better. So which one is better now in these two?
Nifty.
Higher the better, right? So that's how you do the various metrics. Now you can plug and compare and choose what is preference to you. So how do you choose? Basically, you want to generate alpha and you want to be low R squared. That has to be positive, right? I mean, you have to have a and R square needs to be lower. That's the benchmark. Lower in the sense, somewhere lower than say 80 or whatever. And then Sharpe ratio needs to be high. So that's how you calculate various CAPM metrics. So the standard deviation anyway we have calculated. And we have also calculated CAGR and maximum drawdown and things like that in other sheet. So we'll compare all of them and arrive at what to choose. Given a choice, only one. I've given only choice of Nifty Bs and Bank Bs. So you are selecting Nifty Bs because there is no alpha in Bank Bs because it's a negative alpha. And R squared is, okay, if alpha is positive, then we would have looked at this number. Because alpha is negative, there is no point in looking at R square. Then coming back to the Sharpe ratio, Nifty has a higher Sharpe ratio. So I choose Nifty versus Bank Nifty because there is no alpha in choosing Bank Nifty and the Sharpe ratio is high for Nifty. Right, so that's, I think, end of our slide. Just go back to the slide. I think so. Yeah, so we are done for the day. Any questions you can write or you can comment. We'll try to reply. Otherwise, we are done for the day, right? Thanks, guys. Thanks, Reena and Priyanka and Sweta. If you have any questions, you can write there or you can comment. I will try to clarify yours. Thanks for your time, and we are winding up the session.
Thank you, Cora. It was very insightful today.
All right.